Welcome to Trading Nation. I'm Brian Sullivan. We're pleased to be joined now by Dick Bove, Vice President of Equity Research with Rafferty Capital. Dick, always a pleasure to get your insight on banks, and there is no small measure of things to discuss. Before we get into deregulation or the chance of deregulation, what it might mean, you've got kind of an interesting analogy as to what a bank is. We tend to overcomplicate them. What do you think, and tell our viewers what you sort of perceive a bank to be in a layman's way?
Yeah, well, I think, Brian, they're very simple. The same as a manufacturing company. They take in a raw material, which happens to be money, deposits, capital, borrowings. They remanufacture that raw material, and they sell these products, which are loans and investments. And therefore, when you assess a bank or the core, earnings power of a bank, that's where you have to go. Do they have access to the raw material, and do they have the ability to sell a finished product? Now, because they have the ability to gather funds and to remanufacture them, they can use them for other people as well as themselves, and that's why they're in asset management, wealth management, investment banking, and money movement or payment systems. But that's all a bank is. It isn't anything more than that.
Okay, and so what does that mean then when we've talked plenty about deregulation and the cost of regulation on things, on companies that make stuff, and if we remove some of that, it literally just helps their bottom line and maybe will increase earnings. Is it that simple? If we get kind of a pullback in bank regulations, the same thing applies?
Well, yeah, what you're looking for, because there's an awful lot of noise about interest rates, which we can go into. I just don't think interest rates are that important, when it comes to the earnings of a bank. What you really have to look at when you're looking at whether we're getting deregulation or not is, are they making it easier for the banks to get at the raw material, or are they making it tougher? And then on the other side, are they making it easier for the banks to sell their products, or are they making it tougher? And what happened, a couple of days ago with the resignation of Mr. Tarullo, we went from a regime of making it awfully tough for the banks to get at the raw material and awfully tough for them to sell their products to what I believe will be a regime of making it a lot easier to get the raw material and a lot easier to sell the product.
Are there any one or two banks that would benefit from this reduction in, quote, raw materials prices more than others?
Well, it doesn't matter what the price is, right? In other words, let me step aside for a second, okay? Basically, people think that interest rates are critical to bank profits. There's absolutely no evidence of that ever, anywhere. In other words, if you take the period from 2010 to 2015, which you would have to argue is low for long because they were the lowest interest rates that we've seen, I think, ever in this country, and it was a long period. It was 6 years. In that period, bank earnings went up in 5 of the 6 years, and in 2015, when people were arguing that banks could never make any money because interest rates were too low, the banking industry posted the highest returns, highest profits ever in its history. And another quick example, people would argue that in an inverted yield curve environment, banks simply can't make money. Yet from 1966 to 1982, the yield curve was inverted 47% of the time, and banks never had a down year. So, I mean, you got to forget all this interest rate junk, and you got to concentrate on the ability of the banks to sell the products. And what we're seeing is that just about every bank in the United States is going to benefit enormously because they have a tremendous amount of excess capital and excess liquidity, and they're now going to be allowed to take that excess capital and liquidity to put it to work to make money. And how are they going to make the money? Well, selling the loans. And the loans that they're going to sell this time around are not consumer-oriented, but they're commercial-oriented, because under the Trump programs, he's got a whole series of commercial programs he wants to put into effect.
Yeah, regulation and Daniel Tarullo, the Fed stepping down, maybe all good things for the bank stocks. Do you have one in particular favorite right now, Dick?
Well, I mean, Bank of America continues to be my favorite because it's still selling at a discount to book value. The company has, the ability, because of this tremendous amount of excess liquidity, to put that money to work in making loans. It's positioned all over the country, so it has the ability to make those loans in the commercial sector. And I think, despite the fact that the stock has had a terrific run in the last 6 months and over the last 3 or 4 years, I still think it's a $30, $35 stock, so I think it should be bought.
Okay, should be bought. Very bullish view there on Bank of America, $24 stock right now. Dick Bove of Rafferty Capital. Always a pleasure, Dick, to get your insight. Thank you for joining Trading Nation.
Thank you, Ryan.
Folks, thank you for tuning in. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.